So as we step into March, the official tax filing season have started. Now by now you probably have started receiving different T-slips everywhere in preparation of your tax filing. Many people have been asking me for past months to make a video talking about how to reduce more tax, what kind of tax tips they can be aware of. So in this video, I'm going to talk about the top 15 tax deduction or credits you should pay attention to. And at the end, I'll wrap up by talking a little bit about foreign asset reporting, because a lot of people have foreign asset and they're not quite sure how or what to report on it. So without further ado, let's jump into today's video. Alright, so before we start, a quick reminder is that tax filing deadlines are different for employee and self-employed. For employee, it's April 30th of this year, while self-employed have up to June 15th of this year to finish their filing. However, no matter which side you're on, you have to pay all your tax owing by April 30th. So even if you're self-employed, I highly encourage you to get your filing done before April, just so you know how much tax you're going to pay. But if you're the type that likes to, delay until June, then at least guesstimate how much roughly you might be owing and pay a little bit more than your guesstimate, just so you don't owe anything and accrue interest for the 2 months that you're waiting to complete your tax filing. Alright, so next let's talk about the top 15 deduction and credit you should pay attention to. Now for everything I talk about here, I'm going to include a link directly to the CRA website for that specific deduction. So if you want to read more into it, you can go check the link in the description below. So the number one deduction is the child care expense. So with this, you can claim up to $8,000 in child expense for kids under 7 and $5,000 for kids 7 to 16. Now expenses include daycare, summer camp, overnight boarding school, caregiver expense such as nannies, for example. Now generally when you write these off, it is the spouse with lower income that claims them. So even if the spouse have zero income, that would be the spouse that claims them. However, there could be some exception that lets you claim at the higher income spouse, but you need to check the link below for those details. Now moving on, the second biggest deduction people can usually do is spousal support payments. So spousal support payment is tax deductible for the person paying it and taxable for the person receiving it. However, if you are paying child support right now, child support is not tax deductible, nor is it taxable for the person receiving it. So over pandemic, I've heard a lot more stories or discussion about separations. This might be something that you want to pay attention to because one is tax deductible and taxable, the other is not. Now, third big deduction is student loan interest. If your student loan is from the government, the interest that you pay are tax deductible. And this is also why government student loans are a good debt, because the interest you pay are tax deductible. And so if you're prioritizing which debt to pay off, generally government student loans should be at a lower priority because you at least get some tax advantage by holding onto them while you pay off other debt. Now this brings me to the next deduction, which is interest you pay on investments. As long as you incur this loan that is intended to generate income and not in a TFSA, RSP, RESP, or other registered account, you can write this off. So for example, if you borrow $100,000 and you put it into a non-registered account, maybe you're trading stocks, maybe you're buying funds, the interest you incur for that $100K, you can write off against your income. Now, one special note I want to bring up is a lot of people like to use the HELOC or line of credit to pay for pre-sale down payments while it's being completed. I've actually called into CRA because I had a case like this before, and an agent, after checking all the rules, got back to me say that you cannot write off interest if it's for a down payment in a pre-sale, because technically right now there's no physical property, it's just being built. It's still a piece of paper for now, and that piece of paper is not income generating because you can't rent it out, you can't have any growth on it, so you cannot write off those interests. So that's something you want to keep in mind if you're using line of credit or HELOC to pay for your pre-sale down payment. Alright, so number 5, we have the new work from home method. Now this is a video I've recorded previously, so if you're not sure what this is, check out the video I have right here, which talks about that in detail. But generally speaking, if you qualify to claim one of the two methods, you should at least use the flat rate method to get the $400 right off. However, if you're renting, so if you're a tenant, you're paying rent and you qualify, in most cases, you're probably much better off using the detailed write-off method if you're renting, because you can write off the rent, but you cannot write off your mortgage payment interest. If you're not sure, head over to that video, watch it, and then see which one of the two you want to use. Now, moving on to number 6 is to deduct your professional and union fees that you incur during the year. So most professional association fees, malpractice insurance, union fees are tax deductible. Also, you may be eligible for any GST or HST refund that you have paid previously. If you're not sure about this, check the link below or ask your human resource department directly. Most of the time, they will know exactly what you need to claim, what you can claim, and how you should be claiming them. So if you're not sure, ask them about it. Now for number 7 is the easy one, is to deduct your education and tuition expense. Post-secondary tuitions can be deducted either by the student or transferred to a qualifying relative. Make sure you get the appropriate form from school because you need that to file that tax. It will be a T2202 for Canadian universities and a TL11A, C, or D for other university or situation outside of Canada. Now, if you're not sure, ask your school administration department about it, but most of the time, you can download these forms online through the student portal. So make sure you check it out, and if you miss any previous ones, which I see a lot of clients do all the time, you can get those from school and then do a T1 adjustment for your previous years to claim those credits back. Alright, so before we move on to others on the list, a quick reminder, I have launched a second channel which I will start uploading next week. It's focused on people that wants to build their own business or as a side hustle. In there, I'm going to teach you everything I learned to build my business to a 6-figure business system. And also, if you haven't already, make sure you join our private group on Facebook where you can ask questions and you get more contents. Link is in the description below. Alright, so for number 8, we're looking at deducting your moving expense. So in Canada, if you move 40 kilometers or more closer to your work, your new business, or post-secondary school, you can actually claim those expenses. Now, qualifying expense include storage space, travel expense, temporary living expense, and the cost of canceling list and others. So for this year, this is probably less likely because people are usually moving away from work into the suburb due to work from home. However, on the off chance you're moving closer to your work, business, or school, and it's over 40 kilometers, then you want to claim these expenses. Now, number 9 is to deduct your medical and charitable expenses. So first, let's talk about medical. Eligible medical expense can reduce your tax, even for the ones you pay outside of Canada. I've included a link below to talk about all eligible expense that you can possibly claim. One of the ones that I've had a lot of conversation with clients is IVF can be written off as part of a medical expense, but there are some tiny portion or exception of cost that you actually can't write those off. So I've included a full link below to all the medical expense. So check the ones that you have paid for and see if you can claim them back. Now, charitable donations will get you tax credit. You can carry them forward to 5 years if you like. Now, you do get write-off on the federal and provincial level, but I'm just going to use federal to illustrate the point here. For federal, you get 15% credit on the first $200, and the rest of it is 29% credit. So this is why if you don't hit the $200 mark this year, it's better off for you to carry forward until you accumulated more than 200 bucks. Now, if you have a spouse or common law, you should combine your donation together and write them off together, because that way you only have to go through the first $200 mark once and not twice, and you can enjoy a higher tax credit quicker. Alright, so number 10, we're looking at getting your home buyer amount back. You can claim $5,000 tax credit if you got your first qualifying home and you did not live in any home owned by you or your spouse for last 4 years. So for most first-time home buyer, if last year you bought your first home, make sure you tell your accountant and you claim this tax credit for yourself. So moving on, 11 is to apply for your GST and HST new housing rebate. Now, if you bought or built a new home or you have substantially renovated one, you may be able to claim your GST and HST housing rebate. There is a similar rule for landlord as well. So if you have renovated extensively, you may also qualify as well. But this is quite a bit of info, so I have left a link in the description below. If you want to know in detail, go there and check it out. Now at number 12, you want to apply for provincial and territorial tax credits. So this is in addition to federal and provincial GST and HST. Many provinces or territories have additional credits for certain segment of populations. For example, in New Brunswick, you can claim credit for any safety-related renovation you've done for senior. All the way to BC, you have climate action incentives. So for all the credit you can potentially claim, I've also left a link below. Now, the third last top write-off is write off your capital losses. So if you have investment and you lose money on it, capital loss can be deducted against your capital gain. You can also carry backward for these last 3 years if you have gains previously, or if not, you can carry forward indefinitely. However, for TFSA and RSP, capital losses cannot be claimed because they have inherently extra tax advantage already. Also, as a quick tip, if you have a corporation with investment in a segregated fund, capital losses can flow through and be used on the personal side, which you cannot do for mutual funds. Now, second last top claim is to claim your worker benefits. This is only for low-income workers, but if you're in that range, you can claim these credits. You will get up to $1,381 for single person and $2,379 for families. So for self-employed, if you're looking to write off completely all your expense, it may not necessarily be the best case. You actually may want to leave some income so you can claim the worker benefit, but this is something you need to talk to your own accountant for your own situation. Alright, and the final top write-off is to take advantage of the Canada training credits. So this is to support workers over age 26 by reducing the barrier for professional development. Each person can claim $250 per year for a lifetime maximum of $5,000. This is for eligible tuition and other course fees. So if you took courses last year to improve yourself in your field, make sure you tell your accountant so you can claim this credit for yourself. Alright, so those are the top 15 write-offs and deductions you should be thinking about. Now, obviously, there are much more available in Canada. So like I said before, I've included links down below that take you to the full list that are listed in the Canada CRA website, and there are filters that you can go through, can help you find the ones that you can potentially qualify for and check them out. Now, one bonus topic I want to bring up here is foreign asset. So a lot of clients are always bringing up saying that, hey, should I be filing to CRA about my foreign property, and should I be paying tax on the income I receive? Now, I'm not an accountant, so this is just what I've learned from them, observing them serving their clients, and also things I'm reading online. Now, for this part, a lot of people are confused because there is a rule talking about if your cost of foreign asset is under 100K, you don't have to report it to CRA, and they confuse that with I don't have to pay tax on any foreign income I make as long as the cost is under 100K. It's actually two separate things. No matter what the cost is, you have to pay tax on your worldwide income, and you're supposed to report them. So as long as you're receiving salary, business income, interest, dividend, capital gain on foreign countries, you have to file them and pay tax on it. On the other side, it's about reporting your foreign asset, which commonly you use a form T1135. Now, this form is not about paying tax to CRA. This form is about telling CRA what kind of foreign asset you have. So who has to use this form? So if your cost of the total foreign asset you own, the cost is over 100K, you have to file them to CRA, you have to report them. If it's under 100K, and we're talking about the cost, not the current value. If your cost is under 100K, you don't have to report them to CRA. But like I said, reporting or not has nothing to do if you have to pay tax on it or not. It's two separate things. As long as you have worldwide income, you have to file that every year and pay tax on it. So talking to accountants, they're basically saying 1135 is just to let CRA give a heads up, let them know you have such foreign asset on the side. If you have a large amount from foreign coming into Canada and they know you have foreign asset, then they can cross-reference and look at this and say, okay, this makes sense because we know you have foreign assets, so likely you sold them and this is why you have a large sum of money. Or else, then they have reason to suspect, where is this coming from? Did you not tell us something in the past? Did you miss something, right? Then this is where they want to know more, they want to audit you more. So that's what I got from the accountants. Now again, for more information, I've included links down below. So if you're not sure, check them out. And at the very least, talk to an accountant just so you get a full official answer. Now, do you have your own filing tips or any information you always use to reduce your tax? If you do, let us know in the comment down below so other subscribers can learn from you as well. And also, if you like these kind of videos, I do upload them 8:30 EST every Tuesday. So make sure you like and subscribe to my channel. Click the bell button so you get all the notification in the future. Alright, this is Jacky. I hope you found this interesting. I'll see you next week. Bye.